So why is the stock market breaking all-time historic records while the global manufacturing engine essentially, screeches to a dead halt?
Yeah, that is the exact paradox sitting right at the center of the global economy today. It's it's wild.
It really is. I mean,
Mhm.
welcome to the deep dive, everyone. You look at the ticker tape this week, right?
Oh,
The Dow Jones is just casually blowing past 51,000.
right. And Elon Musk just became the world's first trillionaire on the back of literally the largest capital markets event in human history.
Exactly. But then you look under the hood at the industrial data, and factory floors are cooling, supply chains are choking, and inflation is just proving to be incredibly stubbornly sticky.
Yeah, usually when we talk about a diagnostic look at the economy, you kind of expect a clean X-ray.
Right, like a broken arm shows a jagged white line, the doctor points to it, and you fix it.
Exactly. But when you step into the macroeconomic landscape of mid-June 2026, the X-ray machine is just completely malfunctioning.
We're basically peering at this incredibly complex, interconnected system, trying to figure out what is broken, what's healing, and what's just fundamentally transforming right before our eyes.
And the divergence between financial euphoria and industrial reality is, well, it's arguably the widest we have seen in modern economic history.
Yeah.
We're watching a really rare convergence here. You have massive geopolitical uncoiling in the Middle East, right?
Mm.
Plus a complete philosophical teardown of monetary policy at the Federal Reserve. And then a technological infrastructure leap that is forcing a massive reallocation of global capital.
And they are all crashing into each other simultaneously between June 15th and June 16th,
Yeah.
which is exactly what we are unpacking for you today.
Yeah, that's the mission.
We are taking the stack of data that materialized over the last 48 hours and just cutting through the noise. We're looking at the Bureau of Labor Statistics, the BLS, their May 2026 CPI summary.
Right.
We've got the New York Fed's Empire State Manufacturing Survey, some heavy macroeconomic analysis from Morningstar, and the global flow of capital as tracked by institutions like Chase and Trading Economics.
Because, I mean, the headlines are moving at such an aggressive velocity right now.
Yeah, it's hard to keep up.
It is. It's very easy to get lost in the sheer scale of the SpaceX IPO or, the relief of a Middle East peace framework.
Right.
So my focus today is going to be stripping away the sensationalism and really examining the underlying mechanics.
Like, how does a dropped bomb in the Strait of Hormuz dictate a utility merger in Virginia?
Exactly. Or how does a new Fed chair's communication style alter the capital expenditure of an AI data center?
Right, because these aren't isolated variables.
No, not at all. They are gears operating within the exact same transmission.
Well, let's jump straight into the biggest gear turning the market this week. We have to start with the great de-escalation.
Yeah, the Middle East peace deal.
Right. This tentative U.S.-Iran peace framework, which was brokered heavily with Pakistan and Qatar, is basically aiming to permanently end the Middle East conflict that has been, suffocating the global energy grid.
It's a massive shift.
It is. And just to set the parameters for our discussion today for you listening, the political theater surrounding U.S. President Donald Trump and Pakistani Prime Minister Shehbaz Sharif is dominating every news network on the planet right now.
Oh, yeah. The geopolitical maneuvering is just endless.
Endless. But we are staying strictly focused on the math. We are looking exclusively at the economic and market implications of this framework.
Right.
The political analysis is for other shows. We're not taking any sides or endorsing any political viewpoints from these sources. We're just here to figure out how this reprices global risk.
And look, the repricing has been violent.
Yeah.
When President Trump authorized the toll-free opening of the Strait of Hormuz on Sunday evening.
Literally declaring to the shipping industry to start your engines and let the oil flow.
Right. Exactly. When that happened, we saw an immediate unwinding of the most severe geopolitical risk premium in recent memory.
Just to put some numbers to that unwinding, Brent crude fell 4.5% to around $83 a barrel, and WTI dropped 5.4% to around $80.
Which is huge.
It is, because if you rewind to the absolute peak of this crisis, we were staring at global oil prices touching $126 a barrel.
Yeah, it was terrifying.
I think the casual observer hears shipping lane and thinks of it like, a detour on a highway. But the Strait of Hormuz isn't a detour, it's the central artery, isn't it?
Oh, absolutely. It is the ultimate geographic choke point. In a pre-war baseline environment, you are looking at roughly 20% of the world's petroleum and liquefied natural gas LNG passing through that specific narrow waterway.
12%.
Yeah. So when you disrupt that volume and not just delay it, but fundamentally choke it off, you trigger a systemic starvation of the global energy grid.
Wow.
So the market reaction this week is basically the sound of that grid suddenly gasping for air.
And you can see that gasp ripple instantly into the currency markets. Risk-sensitive currencies immediately caught a bid.
They sure did.
The Australian dollar and the New Zealand dollar ticked up about 0.5% against the US dollar almost the second the framework was announced.
Which perfectly illustrates how Forex markets price in global growth, right?
Right.
Because Australia and New Zealand are deeply tethered to broader commodity demand and the velocity of Asian manufacturing.
They love the suppliers.
Exactly. So if the world is no longer terrified of a crippling, sustained energy shortage, the baseline projections for global manufacturing expand.
Makes sense.
And that makes those commodity-linked currencies significantly more attractive to institutional capital.
But on the flip side, look at the Norwegian krone.
Oh, yeah. Rough week for them.
Right. Up until Sunday night, the krone had been the absolute best-performing G10 currency year to date.
Yeah.
Norway is a massive energy exporter.
Huge.
So when crude is sitting at $126 and Europe is panicking over LNG supplies, the krone is bulletproof. But the minute the de-escalation hit the wire and crude benchmarks retreated, the krone faced immediate heavy headwinds.
It's a textbook currency risk pair reaction. You also saw European wholesale gas prices drop over 6%.
Which is big for them.
It is a critical data point for the Eurozone because they are heading into the summer injection season.
They have to refill the tanks.
Precisely. They desperately need to replenish their LNG reserves for the 2026-2027 winter, and buying that gas at a 6% discount fundamentally changes the inflationary outlook for the European Central Bank.
Okay, but I want to introduce a reality check here.
Okay, let's hear it.
Because I'm thinking about this mechanical unwinding, like turning a rusty faucet back on after a multi-year drought.
Okay, I like that.
You finally get the valve open, but you don't get a steady stream of crystal clear water instantly. You get sputtering, coughing, heavily sedimented water at first.
Right.
And you still have to wait for the actual reservoir miles away to slowly refill. The market is cheering that the handle turned, but the plumbing is still a complete disaster.
That is the perfect visualization of the supply chain right now.
Yeah.
Oh, absolutely. The physical reality of maritime logistics does not operate at the speed of a press release.
No, it definitely doesn't.
You have several structural bottlenecks that prevent that $80 crude from instantly flooding the market.
What's the first one?
First, you have the physical safety of the strait itself. The opening was explicitly authorized for the purposes of mine removal.
Ah, right. The mines.
You cannot simply sail a very large crude carrier, a VLCC, through an active, recently mined conflict zone.
That sounds like a terrible idea.
It is. Naval demining is a meticulous, highly dangerous, and extremely slow process.
How slow are we talking?
We are talking weeks before commercial maritime insurers will even underwrite a policy for a ship to pass through safely.
So you literally have to clear the muddy water before you can drink it.
Exactly.
What about the production side? The ships were blocked, but the actual infrastructure that pulls the energy out of the ground took a beating too, right?
It really did. Oil and natural gas production fields, pumping stations, coastal refineries, they were either taken offline intentionally to avoid targeting, or they sustained actual physical damage during the kinetic phases of the conflict.
Wow.
Yeah, the analysis from Clearview Energy Partners highlights that while some of the newer, more redundant facilities can restart relatively quickly, older infrastructure requires comprehensive structural assessments.
You can't just flip a switch.
No, you have damaged pipelines that require weeks of metallurgical testing before you can safely pressurize them again.
So the source of the water is compromised. And then there's the massive deficit we've been running. I mean, the global economy didn't stop burning energy while the strait was closed.
Right, just cannibalized its own savings account.
Exactly. The inventory drawdown has been historic. The data indicates the world has depleted over 1 billion barrels of inventory.
1 billion. Let that sink in.
So when the strait is fully cleared and the wellheads are finally pumping at maximum capacity, a significant percentage of that newly flowing oil doesn't go to the open market to drive prices down, does it?
No, it doesn't. It has to go directly into strategic petroleum reserves and commercial storage tanks just to pay back that massive energy debt.
Which keeps prices propped up.
Yes. That creates a very rigid floor for prices. You are feeding current baseline demand while simultaneously trying to erase a 1 billion barrel deficit.
So how does that mechanical lag translate to the listener's actual wallet? Because during the peak of this conflict, the national average for a gallon of gas spiked by roughly $1.50.
Yeah, people felt it.
With crude pulling back to $80, what is the timeline for the retail consumer to actually feel the de-escalation at the local pump?
Well, the lag from crude futures to the retail pump is usually a matter of weeks, right? It's driven by the replacement cost of inventory.
Okay, explain that.
So, the gasoline currently sitting in the underground tanks at your local station was refined from crude purchase at $110 or $120 a barrel. Right. The station owner has to sell that expensive inventory before they can take delivery of fuel refined from the new $80 crude.
So they have to clear out the old stock.
Exactly. As refineries process the cheaper inputs, you will see a steady incremental decline at the retail level.
But not all the way back to pre-war levels.
No, because of that 1 billion barrel replenishment issue we talked about, returning to a pre-war baseline where you might have seen crude in the $60 range is highly improbable in the near term. The baseline has just fundamentally shifted upward.
Which brings us to the core of the paradox we opened the show with. We have this geopolitical relief valve opening, crude is dropping, and the market assumes inflation is cured.
Right. But that fundamentally misunderstands how economic damage is baked into a system.
Exactly. Let's look at the BLS data for May 2026. Headline CPI rose 4.2% annually. That is a 3-year high.
Yeah.
Unsurprisingly, the energy sector was the primary driver, up an aggressive 23.5% over the last 12 months. Gasoline specifically was up 40.5%, and fuel oil was up nearly 59%.
That is the raw quantitative footprint of the war manifesting in consumer data.
Right.
But, the headline number isn't actually the most concerning part of that BLS report.
No, it's the core data. Core CPI, which completely strips out the volatile food and energy sectors to give us the underlying trend of the economy, remains stubbornly high at 2.9% year over year.
And if you shift from the consumer side to the producer side, it gets even worse.
Oh, it really does.
The PPI, the Producer Price Index, jumped 1.1% in the month of May alone.
Just 1 month.
Right. Annually, PPI is sitting at 6.5%, which is the highest print we've seen since November 2022.
Now, cross-reference that producer inflation with industrial health. The New York Fed's Empire State Manufacturing Index, which basically operates as a critical leading indicator for regional and national manufacturing momentum, absolutely collapsed.
Fell off a cliff.
It dropped 13.9 points, falling from 19.6 in May down to a mere 5.7 in June. Delivery times are stretching out, and national capacity utilization is struggling at 76.2%.
Now, I want to dissect that capacity utilization number because it's a metric that often flies under the radar.
Yeah, let's get into it.
It tells a crucial story about efficiency. A healthy, expanding industrial economy usually sees capacity utilization operating around the 80% to 82% mark.
Right.
So when you drop down to 76.2%, you are looking at factories with idle assembly lines and completely unused machinery.
And idle machinery is incredibly expensive, right?
Yeah.
Fixed costs don't disappear just because your production line is turned off.
No, they don't.
If you are operating at 76% capacity, the per unit cost of the goods you are producing skyrockets.
Exactly.
You have to spread the cost of your factory lease, your insurance, and your baseline utilities over fewer units of production. That inefficiency directly fuels the producer inflation we just noted.
But here's the pushback that the broader equity market seems to be relying on, right?
Okay, what is it?
If oil prices are crashing this week because of the peace deal, shouldn't we expect all of these terrifying inflation and manufacturing numbers to evaporate in next month's data?
Right, like if expensive energy was the pathogen and we just cured the energy crisis, doesn't the fever break immediately?
Exactly. But that is a very dangerous assumption because it completely ignores the mechanics of pipeline inflation.
Pipeline inflation. Okay, explain that for us.
The supply chain basically operates on a massive time delay. Imagine you run a massive industrial bakery.
Okay, I'm baking bread.
Right. The fleet of delivery trucks moving your product today, the massive industrial ovens baking the bread this afternoon, those operations are running on energy contracts and logistics fees that were locked in weeks or months ago.
Oh, I see.
The wheat you are baking with was harvested, transported, and milled using the $126 a barrel oil.
So the cost is already fully embedded in the physical good long before it reaches the shelf.
Precisely.
Yeah.
Even if the price of crude oil went to absolute zero tomorrow morning, the goods currently moving through the global supply chain carry the embedded historic costs of last month's energy shock. You, the industrial baker, have already paid those exorbitant input costs. You have absolutely no choice but to pass those costs onto the grocery store, who then passes them on to the consumer.
You can't just eat the loss.
No. And that is why that core PPI number, jumping 1.1% in a single month, is such a glaring red flashing light.
Yeah.
It tells us that a massive wave of price increases has already been injected into the industrial pipeline and is slowly snaking its way toward the retail consumer.
It's like the python that swallowed the pig. You can see the lump moving through the system, and it hasn't even reached the tail yet.
That is a very vivid but accurate analogy.
Right. That perfectly explains why prices remain sticky despite energy dropping. But let's connect the second half of that paradox.
Okay.
Why did the Empire State Manufacturing Index collapse right as the geopolitical situation was improving? If the war is ending, why is industry slamming on the brakes?
It is the ultimate margin squeeze. Manufacturers are caught in a brutal vice right now. Well, on one side, they have been absorbing these exorbitant input costs and navigating severe shipping disruptions.
Right.
But on the other side, they are facing a consumer base that is increasingly exhausted. When headline inflation sits at 4.2% for an extended period, real wage growth turns negative.
People just don't have the extra cash.
Exactly. The consumer simply stops buying discretionary durable goods. So the manufacturer is paying peak prices to produce goods that the consumer can no longer afford to buy.
That's a terrible position to be in.
It is. That 13.9-point drop in the Empire State Index is literally the sound of procurement managers canceling future orders.
Wow.
A reading of 5.7 still technically indicates expansion barely because it is above zero, but the velocity of that expansion has hit a brick wall.
So we are balancing on a razor-thin tightrope here. You have industrial growth cooling rapidly, paired with a sticky, persistent wave of price increases that are already cemented into the supply chain. It's the worst of both worlds.
And that toxic macroeconomic cocktail is exactly the problem sitting on the desk of the new chairman of the Federal Reserve.
Oh, man. Talk about walking into a burning building on your first day.
Seriously.
Kevin Warsh was sworn in as the 17th Fed chair on May 22, 2026. The June 16-17 FOMC meeting is his very first time holding the gavel.
Let's look at the exact dashboard he is inheriting. He is staring down 3.8% PCE inflation, an unemployment rate of 4.3%, and a federal funds rate currently sitting at 3.50% to 3.75%.
And just to clarify for everyone listening why that PCE number is so critical, the Fed explicitly prefers the Personal Consumption Expenditures Index over the CPI.
Right.
CPI uses a fixed basket of goods, right? It assumes you buy the exact same items every month, regardless of price. But PCE accounts for the substitution effect.
Which is how people actually shop.
Exactly. If beef gets too expensive and consumers switch to chicken, PCE tracks that behavioral shift. So when PCE is running at 3.8%, nearly double the Fed's 2% target, it means that even after consumers try to downgrade or substitute their purchases, they are still facing massive inflationary pressure.
And Warsh is stepping into this dynamic, bringing a philosophical approach that completely detonates the playbook of the last decade.
Yeah, he is.
We are intimately familiar with the Jerome Powell era, where the Fed meticulously telegraphed every single move months in advance to avoid spooking the markets.
Right, no surprises.
Warsh is instituting a radical departure from that. In his confirmation hearings, he made a statement that essentially redefines the central bank's mandate.
What did he say?
He explicitly stated, inflation is a choice and the Fed must take responsibility for it.
Wow. Inflation is a choice.
The gravity of that specific phrasing cannot be overstated. It is a direct rejection of the prevailing narrative that inflation is purely the byproduct of external supply shocks, like a war in the Middle East or a broken supply chain.
Right.
By saying inflation is a choice, Warsh is asserting that monetary policy is the ultimate sovereign arbiter of price stability. He is telling the world, I don't care if shipping lane is closed. If prices are rising, the Fed hasn't made money tight enough.
To execute that philosophy, he is dismantling the entire architecture of forward guidance.
He really is.
He is shifting the Fed to a purely data-dependent, meeting-by-meeting framework. Analysts are comparing it heavily to the era of Alan Greenspan.
Very much so.
He is even targeting the elimination of the famous dot plot, the scatter plot chart where Fed officials anonymously project where they think interest rates will be over the next few years.
Which is inducing a massive paradigm shift for institutional investors.
I mean, for the last decade, Wall Street has basically been driving a car while the Fed provides a highly detailed turn-by-turn GPS navigation system.
Right. In 3 miles, prepare to cut rates.
Exactly. In 10 miles, expect a pause. That was the dot plot. That was forward guidance. Kevin Warsh is stepping into the passenger seat, ripping the GPS console out of the dashboard, throwing it out the window, and telling the market, look out the windshield and drive based on the weather.
I love that analogy. The weather, in this case, being the incoming macroeconomic data.
Right.
Warsh is essentially telling the financial sector, I refuse to promise you what the cost of capital will be in December because I do not know what core inflation will be in November.
But doesn't that inherently inject massive volatility into the system? The golden rule of Wall Street is that markets despise uncertainty.
Oh, they hate it.
If you take away the cheat sheet, if you remove the dot plot, doesn't that terrify the bond market?
In the immediate term, it does inject volatility because bond traders have to actually model the economy themselves instead of just front-running the Fed's promises.
Which means they actually have to do some work.
Right. But Warsh's structural argument is that forward guidance forces the Federal Reserve into terrible policy traps.
How so?
Well, if the dot plot signals to the market that the Fed plans to cut rates 3 times this year, the market immediately prices those cuts in.
Right.
Yields drop, financial conditions loosen.
Okay.
But what happens if inflation suddenly spikes again? The Fed is trapped.
Ah, I see.
Do they hike rates to fight the new inflation, thereby shocking a market they just promised to accommodate? Or do they stubbornly follow through on their promised cuts to save their own credibility and let inflation run totally out of control?
It's a lose-lose situation.
Exactly. So by eliminating the dot plot, Warsh is preserving maximum optionality. He never wants the committee locked into an inappropriate policy stance just to appease the futures market.
And maximum flexibility requires a totally neutral stance. We're seeing the immediate result of that this week.
Yeah, we are.
The easing bias that defined the end of Jerome Powell's tenure is officially dead. The futures market assigns a 99% probability that Warsh will hold rates steady at this June meeting.
Analysts have coined it the hawkish hold.
A hawkish hold. I like that.
They aren't actively hiking rates to 4%, but they are staring down that sticky pipeline inflation and saying, we are perfectly comfortable keeping rates restrictive for as long as it takes to break the fever.
This hawkish pivot becomes even more complex when you contextualize it globally. We are witnessing a historic divergence in global central bank policy right now.
We really are.
The European Central Bank, the ECB, just moved in the opposite direction of a hold. They actively hiked rates to 2.25%.
Because they are fighting a very different war over there.
Right. Their core services inflation, driven heavily by wage negotiations, just refuses to cool down.
And then you have the Bank of Japan, which is operating on a completely different planet right now.
Yeah, Japan is wild right now.
They are widely expected to hike rates, but not necessarily to fight domestic consumer inflation. They are hiking to defend their currency from absolute collapse.
Because the Japanese yen has been under catastrophic pressure, trading near 160 to the US dollar.
Exactly. And the mechanics of this are driven by the yield spread.
Explain the yield spread for us.
Well, the U.S. Fed has a federal funds rate up at 3.75%. The Bank of Japan has historically kept rates near zero or even negative for decades.
Right.
So if you were an institutional investor, why would you keep your capital in Japanese bonds yielding nothing when you can buy U.S. Treasuries yielding nearly 4%?
You wouldn't.
No. Capital violently flows out of Japan and into the United States. That massive selling of the yen absolutely crushes its value.
Which makes importing energy and food devastatingly expensive for an island nation like Japan that relies heavily on imports. By hiking rates, the Bank of Japan is desperately trying to close that yield gap and stop the bleeding.
Exactly. So if you pull back the lens and look at this macroeconomic canvas,
It's a mess.
it is. You have cooling industrial velocity, sticky embedded inflation, a hawkish Federal Reserve dismantling its own guidance tools, and global central banks hiking rates and fighting currency wars.
Based on every single traditional economic model taught in the last 50 years, the stock market should be a bloodbath right now.
It should be deep red.
Equity valuations should be compressing aggressively as the cost of capital will remain high and growth slows. Yet it is doing the exact opposite.
The market is exploding.
Exploding. Which brings us to the final and perhaps most fascinating piece of this convergence. The capital markets boom. the SpaceX IPO, and the quest for infinite power, the market is entirely ignoring the macroeconomic warning signs.
It is a profound decoupling. The real economy is showing clear signs of distress, but the financial markets are operating in a state of sheer technological euphoria.
Let's put the numbers on the table from June 15th. The Dow Jones hit an all-time intraday peak of 51,671 and then pushed higher to close at 51,857.
Incredible.
The S&P 500 is breaking records, the Nasdaq is soaring, even the Russell 2000, which tracks small-cap companies that are usually highly sensitive to high interest rates, is catching the draft.
And this isn't isolated to the U.S. either.
No.
The Nikkei in Japan surged nearly 5%. And while the financial media points to the Middle East de-escalation as the excuse for the rally, the underlying rocket fuel, and I mean that literally is the SpaceX IPO.
It fundamentally rewired investor psychology overnight. We have never seen a liquidity event of this magnitude in the history of public markets.
The scale is almost difficult to wrap your head around.
Let me try. They listed under the ticker SPCX. They raised $75 billion at an initial offer price of $135 a share.
Okay.
By the close of trading on day 2, the stock had surged an additional 19.6% to hit $192.46.
Wow.
That price action brings the total market capitalization of SpaceX to over $2.1 trillion. It instantly became the 6th largest publicly traded company in the United States, and in doing so, officially elevated Elon Musk to the status of the world's first individual trillionaire.
The institutional appetite was just ravenous. Over 360 million shares changed hands on the first day alone, shattering Nasdaq volume records.
Unprecedented.
The underwriting syndicates reported the order book was oversubscribed by 4 times. You had sovereign wealth funds, pension funds, and massive retail aggregators fighting tooth and nail just to get a fractional allocation.
But let's look at the actual valuation math, because this is where the logic starts to fracture a bit. I'm looking at the deep dive analysis from Morningstar.
Right.
They built a comprehensive discounted cash flow model for SpaceX, and they estimate the fair value of the company is roughly $780 billion,
Okay.
which equates to about $63 a share. The stock is currently trading at $193. Furthermore, the company lost $4.9 billion in fiscal year 2025 as they ramped up infrastructure spending.
So they're losing money.
A lot of money. At $2.1 trillion, SpaceX is trading at 112 times its 2025 revenue. Not earnings, revenue. Are we witnessing the ultimate speculative financial bubble of the modern era? Or is the market legitimately pricing in a fundamental generational leap in human capability?
That is the trillion-dollar question that will define the next decade of capital markets.
So what's your take?
To understand how a 112x revenue multiple is even conceptualized by institutional buyers, you have to look past the rockets.
Past the rockets, okay.
Let's examine the immediate market mechanics first. What we are witnessing is a violent reallocation effect.
Reallocation effect.
Right. Capital is a finite resource. Because every major portfolio manager on Earth feels they must have exposure to the undisputed apex predator of the new space economy, they are liquidating other positions to fund their SpaceX purchases.
Which explains the collateral damage in the sector.
Like,
The data shows that older legacy space and aerospace stocks took an absolute beating this week.
they sure did.
Rocket Lab dropped 10% on the exact same day SpaceX surged nearly 20%. Capital is just being vacuumed out of the periphery and concentrated into the monolith.
Exactly. But why is the monolith worth $2.1 trillion? What is SpaceX actually planning to do with this $75 billion war chest of fresh cash?
Build more starships.
Well, they are not just scaling up Starship launches for the sake of Mars exploration. The narrative that has captured the absolute frenzy of the institutional market is the intersection of the space economy and artificial intelligence.
Okay, AI. I was wondering when that would come up.
Right. They are building the infrastructure for space-based, solar-powered AI data centers.
Okay, stop right there. Because when I first read that in the prospectus, it sounded like pure science fiction.
I know, it sounds crazy.
Why on Earth, or off Earth rather, do we need to put data centers in orbit? What is the fundamental problem with keeping our servers on the ground?
It comes down to the AI energy nexus. The narrative of the AI boom has fundamentally shifted.
Oh, so.
For the last 3 years, the market was entirely obsessed with software algorithms, large language models, neural networks, and the silicon chips required to train them, like NVIDIA's GPUs.
Right, everyone wanted chips.
But the industry has slammed into a very rigid physical wall. The terrestrial power grid simply cannot handle the physics of advanced AI computation.
There's not enough electricity.
Exactly. AI data centers require an incomprehensible amount of raw electricity to run the processors. But more critically, they require an equally massive amount of power and chilled water just to cool the server racks so they don't literally melt themselves down.
Water cooling on a massive scale.
Yes. We are reaching a point where the projected growth of AI compute far exceeds the megawatt capacity of regional power grids.
And that structural deficit explains the massive wave of corporate consolidation we are seeing in the utility sector right now.
Spot on.
The $66.8 billion mega merger between Nextra Energy and Dominion Energy isn't just two boring power companies shuffling paperwork.
Not at all.
They are consolidating their nuclear and renewable portfolios, specifically to create a grid robust enough to handle the surging megawatt demand from terrestrial data centers.
Precisely. The dominant investment theme of the AI revolution has shifted from the software layer to the hard physical infrastructure layer.
Power generation is the new oil.
Exactly. You are seeing this across the entire energy spectrum. Rolls-Royce just signed massive contracts to build small modular nuclear reactors, SMRs, in Sweden and Japan.
Small nuclear reactor.
Right. SMRs are critical because they provide clean, uninterrupted baseload power. Wind and solar are intermittent. They only work when the wind blows or the sun shines.
And AI data centers can't wait for the wind to blow.
No, AI data centers cannot operate on intermittent power. They require 247 gigawatt baseloads, and nuclear SMRs are the terrestrial answer to that demand.
And just as a quick aside on the sheer scale of consolidation happening right now, you also see it bleeding into media and tech infrastructure, like Fox's $22 billion acquisition of Roku. Massive scale is the only way companies feel they can survive the capital expenditure requirements of the next decade.
Yeah, everyone is bulking up.
But bringing it back to the energy bottleneck, SpaceX is proposing a solution that bypasses the limitations of the terrestrial power grid entirely.
By placing the compute infrastructure in low Earth orbit, the physics of space solve the two greatest bottlenecks of AI development: power generation and thermal management.
Explain how that works in orbit.
Well, in orbit, you have access to unmitigated 247 solar irradiance. There is no atmospheric interference, no cloud cover, and if you optimize the orbital inclination, no night cycle.
So free, infinite solar energy.
Yes. The data center has access to infinite free energy. Furthermore, the ambient temperature of space provides absolute zero-cost thermal cooling for the server racks.
So no more massive water cooling facilities.
Right. You completely eliminate the need for millions of gallons of chilled water.
Okay, but how do you get the data back to Earth fast enough to be useful? I mean, latency has to be an issue, right?
That is where the Starlink constellation comes in. SpaceX already possesses the largest satellite internet backhaul in human history.
Oh, right.
They utilize laser-linked communication between the satellites to beam the processed data down to ground stations with latencies that rival terrestrial fiber optics.
That's incredible.
It is. When investors look at SpaceX, they aren't buying a rocket company. They are buying the monopolistic provider of the energy and thermal infrastructure required to run the future of artificial intelligence.
And that is the narrative that justifies a $2.1 trillion valuation.
Right. They believe SpaceX is the foundational utility of the next industrial revolution.
The audacity of the engineering is staggering. But it brings us right back to the central friction of this entire deep dive. Yeah. We are existing in a state of extraordinarily fragile equilibrium.
We really are.
Let's synthesize everything we've mapped out today for you. On one hand, you have the great de-escalation in the Middle East, finally unlocking the Strait of Hormuz, fighting to lower baseline energy costs and cool global tensions.
But fighting against that relief is the reality of pipeline inflation. The embedded costs of the war are still snaking through a cooling industrial supply chain, forcing producer prices higher even as factories slow down.
And navigating that exact tension is a brand new, highly hawkish Federal Reserve Chairman, Kevin Warsh,
Right.
who has explicitly thrown out the forward guidance playbook, demanding the market navigate the storm without a GPS, while acknowledging that the Fed owns the responsibility for sticky inflation.
And all of this complex, restrictive macro friction is occurring in the shadow of a stock market that is aggressively high on the speculative fumes of a $2 trillion space IPO and a paradigm-shifting AI energy boom.
It's quite the contrast.
It is. The divergence between the gravitational pull of the Fed and the escape velocity of technological infrastructure is the defining characteristic of this moment.
So how does an individual navigate this. When the macroeconomic X-ray is this inherently contradictory, what is the actionable posture for a portfolio?
The mandate is absolute, rigorous diversification. You cannot afford to be dogmatic and bet entirely on one outcome right now.
Okay, so practically, what does that look like?
The data suggests maintaining robust exposure to real assets, commodities, precious metals like gold, and energy infrastructure.
Okay.
These assets act as a highly effective hedge against the kind of sticky pipeline inflation we discussed. And they provide a buffer against the extreme currency volatility being generated by the divergence between the Fed, the ECB, and the Bank of Japan.
So you have to build a defensive wall against the macro deterioration.
But simultaneously, you cannot completely sideline your capital and ignore the profound long-term structural shifts happening in technology.
Right, you can't just miss the AI boom.
No. The AI energy nexus is not a fad. The gigawatt demands of next-generation compute are a physical reality, regardless of whether SpaceX's specific $2.1 trillion valuation is ultimately justified.
Okay.
Holding exposure to utility infrastructure, nuclear development, and the foundational picks and shovels of the space economy is the offensive counterpart to that defensive wall.
Balance the defense of real assets with the structural offense of the grid. It
Yeah.
makes perfect sense.
Yeah.
But before we wrap, I want to introduce a final variable to this equation, a provocative thought experiment regarding this massive market rally that we haven't touched on yet.
Oh, let's hear it.
SpaceX just went public, and the volume was historic. But the vast majority of the equity in that company, the shares owned by early employees, the founding engineers, and the early-stage private equity firms, are currently locked up.
Right, standard IPO rules.
Exactly. Under standard IPO regulations, they legally cannot sell a single share right now. However, the S-1 filings note that SpaceX has a massive lockup expiry, scheduled for December 2026.
Oh, wow. Yeah, that is a systemic milestone. You are talking about unlocking hundreds of billions of dollars in dormant, highly appreciated equity.
Exactly. When December hits, thousands of individuals and funds who have been holding this private, illiquid stock for over a decade, who just watched their paper wealth explode to a $2.1 trillion valuation, will finally, legally, be allowed to hit the sell button and cash out.
That's a massive wave of potential selling pressure.
So here's the question you have to ponder as you look at your own exposure. When that lockup expires in 6 months, will a massive, unprecedented flood of insider selling trigger a brutal winter volatility shock that brings this entire tech-heavy market crashing violently back down to earth?
Oh.
Or will the institutional hunger for these orbital AI data centers be so intoxicatingly strong that the broader market easily absorbs the massive wave of selling, buys up the dip, and continues its astronomical rise without missing a beat?
That is the question of the year.
Keep your eyes on the stars, but watch out for the mechanics of December. Because right now, we are all staring at that diagnostic X-ray, searching for a clean, obvious break.
But in a global economy this interconnected, there are no clean breaks.
No. There is only the murky, highly complex reality of a system in profound transition. We will keep dissecting the data and looking through the murk for you. See you next time on The Deep Dive.